market risk. We're going to look at earnings growth and potential risks to the market going forward. And then finally talk about why we think the S&P valuation scenario, although we see quite a few advisors using the financial crisis as sort of their default, their standard downside risk scenario, why we believe the S&P valuation scenario is perhaps a better scenario to use for that. And we'll talk about that in more detail. All right. Raj, I believe that you're with me now.
Yes, I am. Thank you, Praveen.
Excellent. Well, why don't we jump right in with the skinny and why we chose this topic?
Well, this topic is really ripe. We notice the rapid earnings growth right now. Feels like Tony Montana, that scene in Scarface, when everybody's earning money and everybody's doing well, and the bankers, the drug dealers, if you remember that scene, and that big blimp goes across the world as yours. Times were flying high. So that's exactly where we are now, in a period of rapid earnings growth, and basically one-to-one on growth and stock price appreciation. So people think those go hand in hand. We'll talk about whether that's true or not. Michael Kitces, who's kind of a tech pundit and a pundit for advisors in general, he's been talking about risk tech and how in this big melt up over the past few years, risk tech is popular, including us, including Riskalyze, and even the big boys like Morningstar or BlackRock have caught on and tried to do something to catch up. In any case, in that popularity of risk tech, a lot of advisors are unfortunately making allocations that they might not make, too conservative, and so that's why we include upside scenarios. But it was ripe to discuss the PTSD from the financial crisis and just help end that, or at least not trigger that kind of trauma in your conversations with clients. And then the other thing is new highs. Now officially on the Dow as well as the S&P. We don't consider the Dow nearly as much as the mainstream media, but there are new highs across the board, and so it becomes really ripe to kind of discuss: are we in irrational exuberance? Is this triggering my nervousness, and what happened 10 years ago? All right.
Well, to start, let's take a look on Hidden Levers, and we'll look at one of the things that we wanted to talk about here actually was how we are modeling. We've gotten this question a few times. So if I go to the scenario library in Hidden Levers and we look at, of course, the financial crisis, as many of you know, is located in the past crashes scenario group. And if I go in there, we see a range of different scenarios, two of which are two versions of the financial crisis, and we'll talk about that more. But of course, along with all these scenarios and every other one of the core things that drives the Hidden Levers model is the regression analysis that we do. And one of the aspects of that is the regression time frame. Now, for a long time, we've told everyone for many years that we use a 10-year time frame for our longer regressions. And when asked why, the answer was, we want to cover a full economic cycle really a full market cycle, including both a correction and a bull market run. Well, now what's happened now here at the 10th anniversary is that we're seeing the major recession rapidly fade out of the picture. And so what Hidden Levers is doing is we have actually, from a regression standpoint, we've pinned the beginning of our time frame. If I actually use our custom charting here, our regression time frame actually starts on August 31st, 2008, and it ends at the current time. And it's going to remain like this until such time as we have a meaningful change in the economic cycle. So as long as the bull market run continues and GDP growth continues to be positive, then we're going to keep our regression cycle getting longer and longer. But the goal being that if and when the market eventually turns down again, which, the downturns always do come, then at that point, we can free this up and go back to a 10-year cycle. But just so everybody knows, that's the way that we're approaching it, so that we ensure that there's integrity in our results, that we're looking at a full economic cycle and a full market cycle, and not just a 10-year window where all of a sudden valuable data ages out.
As we'll see with the case. mean, you know who's not doing that is the robo-advisors.
Oh yeah, well, robo advisors. I mean, I was just gonna, as we'll talk about in a bit here, the Schiller PE, which is of course it really is, it's a great metric, but it is defined as being 10 years long, and so the age out phenomenon will be impacting that shortly.
Well, so the big takeaways from this, if you don't have time to stay for the presentation, mainly, the idea of discussing a 50% drop as your baseline drawdown is really not wise. Not in your practice, not in your allocation, and definitely not scaring the heck out of your clients for no reason. Mainly a 50% drop is possible, but it's probably not going to happen. And so, in terms of discussing risk, probably better to discuss something like a 20% drop, a typical recession, something like that. Things that are garden variety max drawdowns, as opposed to scaring the heck out of everybody with a once in a generation item. That's your job is selling more assurance than sensationalism and alarming them. And so, the appropriate approach we think to risk is use the S&P valuation recession outcome as opposed to the financial crisis. Money Guy Pro and several other platforms, when they do address risk, they always have this 50% haircut. We just don't get why. That's unnecessary, especially, and it leads to that Michael Kitces criticism of creating allocations that are way too conservative, especially in this market, and then not taking advantage of it. The rapid earnings growth we're seeing right now, we should be wary, because often, as we've seen in history, that kind of earnings growth is pretty often coupled with a earnings collapse. It isn't a gradual decline or reaching a new plateau of higher earnings. Earnings are very volatile, and that's just that. In terms of the constant comparison we see, with the 10 years ago and how things are now, they're just very different. And so we'll be going through all that. Praveen, back to you, and let's get started on differentiating these drawdowns between especially 2008 and then the rest.
Absolutely. And maybe if you want to pivot into the full screen mode there, Roger, we can see it a little clearer. But yeah, the first thing we wanted to look at here was to look at the four major crises, which, when looked at on a real basis, all of these actually exceeded 50% in total drawdown. You can see the index, S&P 500 index MDD, that's actually total return basis, so it's adjusted to include dividends. When you look at just price return, then you'll see that all of these, roughly touched 50% or greater. And actually, when you bring inflation into the picture, 73 with the OPEC oil embargo, as a result of the inflationary piece, was actually substantially worse. At any rate, all of these are the four sort of great bear markets of the last century. And we wanted to look at the three of them. The Great Depression, of course, stands out. So we kind of made that the upper left chart because it took such a long time to recover. And then the three at right are post 1970. But you can see in the table below, you can see sort of how long it took to go from top to bottom, and not that different, honestly. The Great Depression was 33 months. The fastest was the 2008 financial crisis at 17, but not nearly as huge a difference on that front as on the trough to baseline. Now, bear in mind, some of you may be familiar with the notion that for the Great Depression, it actually took from 1929 to 1954 for the Dow Jones and the S&P, if it had existed at that time, to get back to flat on a price basis. And that's true. It was 25 years for the Dow Jones to get to the exact same value that it had in 1929. So these numbers, again, this is total return. Yields were actually quite a bit larger back in the 20s and 30s than they are today. I mean, stock market yields, they were more like 5% instead of the 2%, which we might think reasonable today. And so as a result, that helped shorten that trough to baseline. It's still over 10 years and 132 months, 11 years, so until 1940. It's still a heck of a long time to wait. And so the Great Depression is about double the other ones. But the last bit that was interesting was that the rally beyond baseline number, if you look at that, it's you see that the 2000 tech crash, and I believe we've noted this in the past, but the recovery after that crash is almost kind of a recovery within a bear market, because no sooner did that end and by 2007 we gotten 2.4% above the 2000 high, and then we crashed again. So really, you could think of that era really as being all part of one big cycle. With that said, the 87% that we've had since the 2007 highs to the new highs that we've made today, if that doesn't sound right, because you're probably used to hearing how far we've rallied off the lows, when people talk about bull markets, here we're talking about, well, the S&P was actually in the 1560s at the 2007 high. Here we are close to 3,000, so we actually aren't quite double yet in terms of that price return. And so 87%. So in that context, in sort of the longer term trend context, we're not necessarily totally bent out of shape. Not just yet. We've run part of the way. Roger, if we go to the next slide, I think you have some nice context here on how it looks when you really look at that speed of recovery, as opposed to like not necessarily where we're going to get long term, but speed of the recovery. And really the fact here that, so this is the same four markets. The financial crisis in blue there is flying up above. And now this is inflation adjusted. We thought, that's important. And this is a chart from Doug Short over at Advisor Perspectives, and they do great work on sort of long-term valuations. So here they took all four crises and they put their peaks at the same point in time and then measured in years outward from that peak. And you can see how the financial crisis recovery has been much faster than the other recoveries. Now, on the previous slide, we talked about how the overall return since recovery hasn't yet been outlandish, and that's true. But that's also because the rallies that we were talking about in those other three, post 1973, you're actually talking about the 1980 to 2000. So, for instance, that's 20 years. We are actually only about 5.5 years past the point. If you go back to that next one, so the point where we cross over to the zero line, it's right around the 5.5 year mark on that blue line, and so it really hasn't been that long yet. So it's a fast recovery, but we still got potentially a long way to go if this is a true new secular bull market, and so that. The speed is a bit questionable, but the eventual destination, is not necessarily.
Okay. Well, here we have, where are we right now? Should we take a pulse check on where the risks are? And so we are seeing 2s10s Treasury spread flattening out. That is a risk for us. We saw a rate hike yesterday. And so those numbers are getting closer. As we know, yield curve inversion is something we've covered in the past and is in the Fed Hawks scenario. So that's there for you. Definitely one of the more prominent risks that make us pause in terms of the optimism and all the things dealing with earnings. The CAPE ratio, the PE ratio put forward by Robert Schiller, that is also a risk. It is rising. We'll be discussing the valuation scenario at the end here in our updates to it. So that is rising, though. It's been at around 33. It was flat even I would say in the whole since the end of the Obama administration and through the Trump administration. You've had, as that rally happened, even before the tax plan, their corporate earnings did surprise to the upside. And so as that number has been rising on corporate earnings, the valuation has been staying flat. And so that is rising, though. So that's something you want to monitor as a risk. Oil prices.
It just sort of exploded upward. I mean, most of it, if we look at the rally from the 2009 lows, of course, that CAPE, PE fell super low and then bounced back. But as you're saying, like that 2014 to roughly 2017 era was relatively flat, and then all of a sudden it took off. And so this most recent leg of the rally has not been, has not been as backed up by at least the long-term earnings to show our PE.
Mm-hmm. And just to finish up there, oil prices back in 2008, where the whole rise, I think, is up to about $150, and then the crash from there, that presaged everything, that kind of commodities walking off a cliff. And so today we are rising, but it's not even, the slope is very different. And it almost seems to me, because America's a producer, oil is kind of a non-factor in terms of in how we deal with corporate earnings, the S&P, its prominence, etc. Okay, so if we're going to compare drawdowns properly, let's talk about 2008 and 2018. A lot of sensationalists want to make them the same. Hey, here we are because housing is kind of eye-popping numbers, and that yield curve inversion is looming. So maybe there's all these similarities, So the one we found that is worthy of note is that high-yield credit spreads are at their lows, and there's nowhere to go down from here. And so that second half of 2007 is when they started spiking. You can see that chart credit spreads are kind of falling or low. Where are they going to go? They really can only go up. People say similar things about volatility in general, the VIX. And so, this is to let you know that if credit spreads start rising quickly, that's your kind of ticket, right? The bond market, the fixed income market is early tells in terms of danger. But we are at those lows, but it's not like it's going to be a gradual rise. The differences are a lot easier to find. I mean, they are abound, right? Earnings growth is much higher in this cycle. In terms of the housing prices that are appreciating in that same slope, you see that on the lower left. The amount of housing inventory, though, is not even close to the same. There was a total overage of housing inventory in that 2008 period, and that became the bubble. It was around the housing bubble. Is there a housing bubble now on pricing? Definitely, we're seeing prices relaxing a bit. It depends. It's really different. They're coastal, especially with the coast. So, but here, in terms of nationwide, there's no glut of housing inventory. If anything, it's lower than the average housing inventory, which is usually about 6 months. Okay, it's probably half that right now. In terms of the corporate taxes, huge decrease there. So that is a forever change going forward, and so maybe that does affect that earnings growth. The Fed, one of the other major things, I can't say this loud enough or enough times, the Fed's not fighting inflation like it was in 2008. Right? Oil prices did hit $150. That was driving inflation in a lot of areas down the food chain. But even their raises, they're raising because if you look at our interest rate scenario, right, there's a huge distinction between the Fed catching up with inflation, which was the mid 2000s into the financial crisis, and then now, which is just keeping up with GDP rising and getting back to the old normal. It's just distinguished completely. The Fed is not fighting that inflation. And that goes with the lack of a commodities bubble, right? So not there.
Yeah, so it really, well, that's the outlier, 29, because of course we actually went down almost 90%. When you look at all of the other cases, these other three, it really doesn't add up to much. If we look at the chart on the right, that's what we're showing is that the percentage of the time the market spent down more than 50%, and this includes the Great Depression, is only 4.5% of the time. But now here's the kicker, and this is the thing that you may not realize. In fact, we didn't realize this before we did the research. If you exclude the Great Depression, there's actually only been 1 month literally only 1 month since the Great Depression that the market has been down over 50%. That was the bottom of the 2008 crash. So 0.1% of the time. You can interpret from this sort of probabilities as well. So you can expect kind of on a go-forward basis, not on a go-forward basis, but sort of over a long-term picture, that 0.1%, that's your kind of probability of a 50% kind of crash. Those are not as common as investors and or even advisors might think. Whereas the 20% downturns are actually more common than investors and advisors often kind of consider them, because those happen twice a decade on average. So that's really the key takeaway for us, is that the big crashes that everyone's so afraid of, you know, there are investors and advisors that have actually spent their entire career and managed to avoid them. But the small 20% corrections and even 30% corrections happen reasonably frequently, and you know, we should be prepared for those. All right, and so let's jump now to talking about earnings in the market a little bit. And you know, we've already talked about this subject a little bit, but we want to talk about both specific earnings growth drivers and potential downside risks. There are, you know, so many of them that you hear about on both on the internet and HiddenLevers. You know, at HiddenLevers we've done, you know, our work to try to bring many of them to you. But let's start with the earnings growth drivers. So the first one, you know, we put it in gray because it's not sort of a real earnings growth driver, but it's important in terms of a valuation metric that Wall Street uses, that many advisors and investors use, and that would be CAPE, or the cyclically adjusted PE ratio, also known as the Shiller PE. So it actually uses a 10-year average of earnings. And why does that matter? Well, it matters because here we are, we're coming into Q4 of 2018, which means that 10 years ago is Q4 of 2008, which means that 2008 is starting to be in the rear view mirror. Earnings were already starting to deteriorate in 2008, and then they hit their bottom in Q1 2009. So by the time we get to Q2 of next year, the worst quarters will be out of the 10-year average.
And so you have the denominator really going up in the PE ratio. Absolutely.
And so what that means is that the PE that we see today, or rather the CAPE that we see today, is around 33, actually 33.5 as of today. Just because of this effect alone, even if actual S&P 500 earnings didn't rise at all, we would expect to see the CAPE drop to around 30 just on that basis. So it does make for a meaningful shift, and to the extent that market players or participants are using that in their thinking about whether or not the market is overvalued or fairly valued, well, that takes some of the edge off. Now, 30 is still a very high CAPE, you know, in terms of historical averages.
But it's below here.
But it's below where we are now, absolutely. And that's not taking into account any actual earnings growth, which of course we're continuing to see, both because of the strong economy, you know, now, so this is some of the other growth drivers. So the tax cut stimulus, the tax cut plan, so it has two impacts. One is it straight up juices earnings because earnings for public companies are after taxes. And so you cut your tax rate from 35% to 21%. It's not a huge surprise you're going to see earnings jump. You should see it. But there's a second impact there, which is that $150 billion a year, roughly, or estimated, is being injected into the U.S. economy. So it has an actual stimulus effect, not just the paper metrics stimulus.
I hate to use the word, but trickle down effects.
Yeah, you know, so potential trickle down, that's right. Then you've got the budget caps removed. So what is that? This is the 2012 era budget caps put in place by President Obama and Congress. And so the GOP Congress and the president at that time agreed to cap spending both on the defense side and the non-defense side. So those were removed by President Trump and the Congress last year. Actually, I'm sorry, I believe it was early this year. At any rate, that injects another $150 billion a year into the economy over the next 2 years. It's a mix of defense and non-defense spending. But one thing to remember about defense spending is that it's essentially 100% domestic. You're not allowed to produce even components for things like missiles overseas, generally speaking. So that's a lot of defense spending, or a lot of spending that is a form of stimulus as well. Finally, all that stimulus together is accelerating GDP growth, and GDP growth seems to be picking up, over the last several quarters at any rate. So with GDP above 3%, that's something that we haven't seen since the financial crisis. So those are all net positives. All right, so if that's the positive picture, then Raj, what are some of these, risks that, we scoured the internet, right? Found some things that are.
Yeah, there's no shortage of haters out there, and so most of it's fear mongering, and if you're able to, hold on a second. If you're able to get past that, the real risk to earnings growth is just volatility of earnings. Are these 20% earnings growth across the board, is that sustainable, right? If you have the big the blue chip names like a Boeing, like a McDonald's, surprising to the upside, and then all the way to the newcomers, they're all surprising to the upside. So how many times can that happen? Is it just a new era of consumption, or is that due to reinvesting the tax plan benefits? It could be a number of things, but the idea is, people are, the big risk to stock valuations is that earnings growth actually diminishes a little bit. These actual, kind of risks are the ones that you see there on the right. They're all BS from the web, but the real one that you might consider isn't so sensationalist. It's just, will that kind of earnings growth continue? Mostly 20% earnings growth is kind of, is not a sustainable thing.
Right.
We had a question. Let's go to that now. Does the 50%, 4.5% drawdown mean the total of days time the market was below or at 50? Yes, exactly. That's what that means.
Right.
So how many days or months was the market 50% in a 50% correction? And the answer is 1 month since the depression.
Right. All the rest of that time was in that 1930s era.
Yeah. I would say that since then we've never, maybe 1 month.
It was 1 month. It was 1 month in early 2009. Was the only other time.
The only other time since the depression. So that, the takeaway from that, to answer that question, is don't make a 50% haircut your usual haircut.
Right.
It did happen to NASDAQ too, I guess, in 2000.
It did happen to the NASDAQ.
But not the market overall.
Well, the S&P did eventually close down just shy of 50% by the time you get to late 2002. It didn't quite hit that 50% threshold. On a total return basis, more like the low 40s. So yeah, it's rare to go down that much, and that's not the only thing advisors should prepare for.
Yeah, you may title that worst case scenario ever, but probably as you're courting somebody, it might be good to be more optimistic or just more even-handed about how you talk about things. All right, so let's talk about correlation to stock prices. Earnings growth and stock price growth. Here on the left, we've set up some different eras. You got 1920 to 29, huge up market. That was the roaring 20s, 600% earnings growth. And the S&P not quite as high. It wasn't as roaring on the S&P actually. But nonetheless, the 2 years that followed after the crash, you've got a earnings collapse. And after that, we all know what happened. It's not even worth talking about the downturn there, the max drawdown, from HiddenLevers. But it's the Great Depression. It was a big epic fail that this kind of pattern is repeating. So 82 to 2000, the whole boomers coming into market, all the way through to the year 2000 and the dot-com crash. 850%, completely outpacing earnings growth. So 100% growth in earnings, but almost just completely trouncing that on the S&P. So really not a highly correlated thing there. But nonetheless, even with that 100% earnings growth, earnings collapsed. And so you see from that, you've got the dot-com bubble. Now, a lot of the 03 to 07 rising was taken with a grain of salt. You can see we didn't even make half the rise in the S&P as we did earnings growth, right? And then that led to the financial crisis. But there was still a reticence to bid up stocks between 2003 and 2007, at least to keep up with earnings growth. And so now that brings us to today, this 2009 to 2018, definitely from the bottom, we've seen excellent earnings growth, 280%, and pretty much a one-to-one rise between stock prices and earnings growth. And so if you have no care for history, then you might say, well, one-to-one ratio of stock price growth growing with earnings growth. And so you'd have a basis for that, nothing to worry about. That's not overheated, it's not irrational exuberance, it's one-to-one, we're keeping pace. But if you take a look at the rest of the chart, you can see earnings growth and S&P growth have zero correlation. So just because it does have one-to-one right now doesn't mean anything. You can see there from earnings, the chart on the right, S&P earnings, this is inflation adjusted, by the way, and the dark periods are the recessionary. Earnings collapse pretty hard. It's not like they just reach a new plateau, you've got a great new earnings plateau to get to, and then it goes. It's very volatile as an economic indicator. So earnings, we don't use it as a lever in terms of the economic model at HiddenLevers because it's so volatile. That the one thing you can say that's somewhat predictive is sharp increases tend to be followed by sharp decreases, and so this kind of overreaction to is the 230% rise in the S&P an overreaction to the earnings growth so far? We don't see it as one, but it's easy to see where the year 2000 that was an extreme reaction to that earnings growth. And if earnings growth does diminish completely, it will happen pretty quickly.
Yeah, and one point to be made here is that you can see it from this chart that sometimes earnings and stock market growth are sort of one-to-one, and of course other times like the 80s and 90s, particularly the 90s, you have multiple expansion, meaning valuations are just rising because people got, in that environment, people got really giddy about stocks potential in that dot-com bubble, so they were chasing out way ahead of earnings. Usually what you see is the other pattern, which is that earnings grow potentially faster, as we see in most of the cases, and that's because those, as Raj, as you said, they're more volatile, so they crash with a hard recession, and then they fly upward and they sort of pull stocks up with them, coming from low multiples to slowly people being willing to invest in stocks again.
Okay, looks like we have a couple questions. I'll take those here. What do valuations look like without the FANGs involved? And how much of the CAPE is affected by just those few stocks and Amazon?
Yeah, well, we looked at it, and as I just had typed in, the so-called FANGs, of course, include Facebook, Apple, Amazon. Netflix typically is the N, and then G, of course, is Google. In reality, the three big movers this year, well, so Facebook has not really moved this year. They've had some struggles. Google has also been relatively flat relative to the others. So it's really Apple, Amazon has been a rocket ship, and has now touched $1 trillion. And Apple, of course, has grown steadily and broken $1 trillion, the first company to do so. And then finally, Microsoft is sort of the quiet tech company that chugs along. So those three are probably responsible. And as we had seen, if you look at, there's other analysis we've seen that most of the S&P's growth this year is due to the so-called FANGs. You decompose that and you realize that, oh wow, no, most of it is actually due to Apple and Amazon with a very small helping of Microsoft. And so yes, it's getting, so that would be the argument of those there are those who argue the market is too top heavy. The counter argument would be, but the economy is getting that way too. So top heavy would matter more if Apple and Amazon weren't dominating as they are. If that's the reality in the real world, then it should be mirrored in the stock market. And it happens to be the reality in our world today that you've got, these super giant tech companies that seem to be crushing everything in their way, for lack of a better way to put it.
Right. That's a good point, Praveen. It does mirror Main Street, where Amazon and Apple are in people's everyday purchasing history. We do have a scenario on the end of retail where it talks about some of that, and the growth of these giants, where we buy everything from them, their market cap growth or earnings growth outpaces completely what's diminished below them in terms of the competitors or other places that are, let's say, losing steam. So check out that end of retail scenario.
Right. We had another question, which I think we'll take to the scenario as we start to talk about the scenarios, but what do you believe will ultimately slow earnings? And I think there, as we talk about the S&P valuation scenarios, that will be a good segue into that, and definitely have some thoughts about it. All cycles come to an end is the basic concept, though. And as we see with the slide that we're on now, all these great earnings eventually collapse because business cycles and economic cycles, and you get recessions, essentially too much capital is invested, too much hoopla, and boom, and then that turns over eventually.
All right, so let's move on to the scenario. Nice segue there. First of all, of course, we do have our historical scenarios. This is just a recap of the almanac that is in HiddenLevers scenario library. We do have past crashes. Amongst them, we've got two financial crisis outcomes. The first one there on the left is the kind of pinpointing that really the high blood pressure days of September, Labor Day, through the following March max drawdown is on the right, where you can see from beginning to end, where late 2007, those hiccups, I think Bear Stearns was still alive in late 2007, and going all the way to March 9th. So, as you can see, most of our users use the financial crisis, just that small movement where things got really crazy between Labor Day and the bottom.
Well, that core 6 months,
yeah,
right?
That core 6 months. But for the 10% of our users that are constantly making max drawdown of the financial crisis, their baseline scenario, stop. That you're triggering people's PTSD from that. And I can't, if I'm an advisor, I wouldn't use that to, I guess I might address financial crisis in some sense if people are around then, or if they bring it up. But I think I'd probably be more positive about things and more opportunity minded as opposed to, getting all that emotional baggage out of my future client. And so that financial crisis max drawdown is there for completeness. I wouldn't use it in terms of your sales process. All right, on to the scenario at hand. S&P valuations, because we are rising in valuation a bit in terms of PE, and because we've got some big events coming at the end of this year, as you said, Praveen, I thought we'd take a look at and try to update valuations. I also think this is, if you're going to have your garden variety downturn, this is a much better place to hang your hat than the financial crisis of 2008.
Right. Yeah. I mean, so I guess we'll start there because, that was the question we got. Maybe we can start and go bottom to top. But in terms of the bad scenario, and then also addressing that question about earnings. So a garden variety recession. So here, when we designed this particular scenario, and we've updated it over time, but when we designed it, we looked at the last couple non-financial crisis recessions. So that means 1990 and 2003. And what we saw when we looked at those recessions was that the CAPE multiple dropped by around 20% in both cases. But we looked at the average multiple as well, and we saw that, it's likely to drop more, if we're at an extended level. So we looked at, okay, what would happen if the cyclically adjusted PE of the market dropped to 21, which is in line with where it bottomed out in those recessions. And bearing in mind that we're at 33 today, but we have to remember a good 3 points are about to get shaved off by just, by those effects that we talked about, where
the organic
earnings are rolling off. So it's not gonna be, that's gonna, ameliorated a little bit. At any rate, when you net all of that out, this scenario calls for a 30% downside. The downside on 10-year yields, so 10-year yields, of course, being just over 3% right now, that's really, typical market reaction moving to bonds and flight to safety. And then also, you would expect, even if we have a mild recession, that the Fed would back off of its rate increases and probably move at least to pause, if not moving the other way, with 1 or 2 cuts. And now here we're talking about a mild recession. We're not talking about, another financial crisis, so to speak. But the question was asked, well, what might get us here? What might get us to, what might lead earnings to go down? Well, first thing I'll say is that the tax cut is a one-time thing. So take a, a typical company. Let's say that typical company is, making 20 cents on the dollar net after tax profit, that they show on their books. And let's say that they were paying 35% taxes. So if their tax rate goes down to 21, then that means that 20 cents on the dollar, well, before it was probably pre-tax something like, I don't know, 28 cents or something like that, and taxed down to 20 cents. So now it's going to be 28 cents taxed down to something like 23 cents. So that's a 15, I'm throwing, rounded numbers out, probably off by just a little bit, but you get the point. That leads to a shift, an upside in earnings of like 15, 20%.
An instant one-time shift.
Exactly. It's an instant one-time shift of 15 to 20%, but you don't get that twice. That doesn't happen next year. So if GDP growth and other factors don't continue to push earnings growth forward, earnings growth is going to be zero, at least on that basis. So that's sort of, let's just get that out of the way. That's going to be drag. It's great today, great in 2018, but in 2019, all of a sudden it's going to be like, oh, well, we don't get that, that freebie anymore. So that's number one. Number two is that rates are rising. And everybody keeps talking about yield curve inversion. We've talked about yield curve inversion, and we think it's an important point and an important risk. But why is it a risk? Well, the simplest reason it's a risk is because it's raising the cost of borrowing. So as companies have to refinance, their costs go up. Concrete example, HiddenLevers bought, an office building for our new headquarters here in Atlanta earlier this year, and our financing costs are rising. It's, it's not necessarily a huge issue, but you can imagine for very capital intensive businesses, it could be. And so that's another thing worth noting. So these various types of impacts, and those are two very concrete ones. The final one is just the typical thing, which is that economic cycles end. And of course, it's hard to predict, but right now we've got a few slides earlier, we were talking about these stimulus components that have been injected into the economy, sort of an economy that was near capacity it's sort of thought to be getting near capacity with unemployment being as low as it is and wages starting to rise. So what if wages start to rise faster? What if companies are having difficulty hiring? Some of those things cause costs to go up, cause profits to go down. That's your traditional reasons that business cycles end.
Right. So we can call all those stimulus packages kind of a business cycle Viagra.
Yeah, they are. And so and the question is, how far does that take us? Ben Bernanke, for instance, is worried about 2020. That's when a lot of folks start to get worried because some of these immediate impacts, meaning the one-time impact of the tax cuts in terms of earnings growth, that rolls off. And then some of this new spending that came into the picture, that potentially rolls off. So that's where, folks are starting to get concerned. But again, you can't predict it exactly, but those would be the ideas.
So yeah, instead of comparing 2018 to 2008, although the number 8 is at the end, and it's nice to say something's 10 years later exactly, there's a poetry there, but the real comparison should be more like 2006, when times were flying high and they didn't have as much worry, but there was definitely clouds on the horizon. That's what we could see. Right, Praveen, would you compare more to 2006 than 2008?
Where we are, again, the exact positioning is a subject of pundit debate. It seems like we're getting closer as we saw some of those metrics, yield curve is getting close to inverting. It may, if things continue on trend, may invert by, let's say, the end of the year or early next year. And those, based on lots of research and so many past events, that sometimes is 18 months out, a year, 18 months out, and so that would put you in 2020.
At the beginning of the year, we had that serious choppiness. A lot of advisors came to our door in January, February because of the 10% correction. When did the tax plan pass? Do you remember?
So yeah, the tax plan was right at the end of last year.
Is that the end of last year?
It was late December, and as it started to kick in and people started to see it in the results, perhaps that's what started to perk folks up again. Chris, you have a number of good comments on, obviously the market being expensive, and absolutely, Kitsis as well, who we mentioned earlier in the presentation, has done some good advisor-oriented research. Plenty of folks have done good research on how high CAPE ratios or investing at periods when the CAPE is high leads to low long-term returns later. And Michael Kitsis has done it specifically for the advisory community. But yes, so those are definitely well known. We're not here to poo-poo that at all, but it's more to ask the question, or really just even posit that result that I'll go back to, which is that since the Great Depression ended, we've had exactly 1 month where the market was on average down over 50% from its peak. So it's not to say that those risks don't exist. It's not to say that those risks aren't real, but we should just look statistically even and say that folks seem a little bit, fixated on that, and a little bit less kind of fixated on the idea that, even the 20 and 30% declines have been infrequent. So you darn well better be ready for a 20 to 30% decline. One last example in that vein, 1982 to 2000 was an absolutely massive bull market, greatest bull market in history, but it had this interruption called the 87 crash right in the middle of it. The max drawdown in 87 was actually 33%, but that doesn't mean that it wasn't in the middle of a big secular bull market.
Right. And so how do you deal with that? Probably the main use of hidden levers if it was existing in 1980s was to not have people panic sell, right? And so if there is a small correction, or right now, even a 10% correction is going to be a heart attack for a lot of people. They just haven't seen that. That would be basically a repeat of January and February. And I just know how all the advisors calling us at that moment felt. The last few years of just this melt up and kind of lack of volatility have made a lot of financial professionals atrophy, right? Except for maybe the emerging markets traders. They're kind of seeing the brunt of
they felt a bit of pain.
the pain lately. But not having that pain, that struggle, makes people soft, and so especially investors.
Right.
And I'm sure you're hearing it when you're not able to keep up with just market returns.
Well, let's quickly touch on the other versions of this scenario. So the baseline, this is just the idea that the CAPE stays flat, which again, we're getting some support because of the negative earnings rolling out of the CAPE window. But so that's just things go smoothly from here, and we continue to grow on the S&P 500 at a relatively conservative pace there, with 5% upside. But I think the good scenario is worth mentioning here, because sometimes investors and advisors alike assume that we are very near the 1999 peak. This good scenario kind of just gives us a sense for there is a decent amount of delta. Now, if we scream up another 30%, well, that's what it would take to get there. At that point, we will literally be back in all-time high territory.
Yeah.
But we're not there yet, and so
the good old days of the Clinton administration.
Yeah, I mean, it could be, it could happen. If it does happen, well, then we know that we're stretched to valuations that have only ever been seen
It
once.
actually lets you know how ridiculous that time was in '99.
It does, yeah. And that's around when Raj and I started our careers, and it certainly was a go-go era, even more than the tech. So if tech feels like a bubble today, well, it just doesn't compare to then.
Yeah, at least today, a lot of people talk about how Apple's actually undervalued based on its earnings and PE ratio. Well, so that at that time it was pretty ridiculous with that 4 handle on CAPE. Okay, and then my favorite outcome here is that kind of 2003 recession, maybe maybe the early 90s Hurricane Andrew, post Hurricane Andrew recession, where it was 21 Cape, garden variety downturn, not much to scream about. It's still 30% down from here. It's nothing to, it's still definitely a healthy correction, but that's, to me, a 30% correction should be your standard on worst case scenarios, not 50%. And if you are dealing with that, make sure you have a good reason for it, because otherwise it's just financial crisis, PTSD.
Yeah, and there's nothing to sneeze at with 30%. That is something a lot of advisors are not prepared for.
Okay, Praveen, let me pass it back to you so we can take a look at this on the Hidden Levers website.
Absolutely. All right. There we go. And if I take a look here, well, I'm still in the financial crisis scenario, but if I jump back into my scenario library just to show everybody where the scenario is, the S&P valuation, well, these are all alphabetical, and we may rotate it back into trending as soon as it's on our minds. But if I jump back into it, we'll see it right here. All-time highs, flat line, typical recession. I will point out, for those who have got the bearish inclination or who want to see it, for reference, that there is, and we didn't mention it as part of the slide there, but there is the 17 Cape as well. So if you want to know what's the long-term average of the Shiller PE, and this is going back, the data that Robert Shiller has looked at, I believe he goes back to the late 1800s. And so looking over that expanded time frame, it turns out that 17 is the multiple that is that super long-term average. And so he's analyzed that, and we posted that here. What would that drawdown look like? And so that's 45%. So it is pretty substantial.
We didn't think it was appropriate to address it. Of course, it is there again for completeness. How, what is our black swan on Cape? But in this case, we felt, in the scenario there, it's for you, for the doomsday type advisors. But really, it's, the good, bad, ugly is comprehensive already at 21.
Right. A question around, is Cape available as a separate lever? So we don't actually include S&P earnings as a separate lever. We may investigate it again. The last time
it's too volatile.
Well,
that's the idea. In fact, if we go to the
well, there are two issues around it. One was that, and actually I can chart it briefly, but one of the issues was that it so some of the levers that correlate too closely, since the S&P itself is in the model, if you have two levers that are correlated too closely to each other, then they tend to that collinearity basically doesn't let the model get a lot of value out of adding additional. So it's for the same reason we don't, for instance, include new home sales and existing home sales or something like that. We just use one number to capture the housing market, for instance. So in that same vein, we haven't. That doesn't mean that we can't take a look at it again and see if it's worth doing. But for right now, we
do have it as a lever in terms of research.
In terms of research and being able to chart it again, and look at it against stocks and things like that, but we don't currently include it in the model as a scenario lever.
I mean, if we remember the slide on earnings growth and correlation to market, it is not correlated at all. It's all over the place. So where things don't have correlative value, we leave that out of the model. It's noise.
All right.
Well, that takes us to the end of this session. Are there any other questions?
Looks like we've got one more. Just a question around, be interesting to toggle that number, and if chosen, you could default to not include the S&P earnings conflict you spoke about. Yeah, and I will say the other aspect, Matt, that we have been asked about in this regard is to include it so that we can have the scenario itself auto adjust based on daily Cape updates. Currently, we do update these scenarios on an ongoing basis, but that's not an automated process. So that's definitely something that we'll consider, is bringing that into the picture from a standpoint of at least having the scenario able to track against it. What I mean by that, if I look over here at the concept of scenario progress, which is of course a very important concept, that's you can see it here in the Cape flatline scenario, this progress bar measuring how far along the way we are. But here it's using the S&P 500 as the measure of progress from 2,900 today to 3050 in that scenario. For the 21 Cape recession, you see it going from 2,900 down to 2,037, but we could measure this potentially even more accurately by making that key lever in this scenario, at least for tracking purposes, making that the Cape. So that's something that we'll keep in mind.
Do you want to go back to the takeaways slide? You've got that deck now.
All right, we'll just let you share that, Raj.
Okay. All right, well, just to, not to belabor any of these points, but if you're here at the beginning, you remember where we started, and that's where we'll end. Probably not the best idea to use a 50% haircut as your baseline drawdown. You're scaring the heck out of people in the biggest bull market where they should be taking some opportunities. And so, if you want to heed Michael Kitz's warning of don't use risk tech to make overly conservative portfolios. So, use the upside outcomes. Don't just use downside crashes all day. It's good to be even-handed as a fiduciary, but also it will make you take advantage of some of the market upside in a better way than just concentrating on downside risk always. Earnings growth is volatile. That's why it's not in the model. And so a lot of times it's going to be coupled with earnings collapses, and that's why we don't do it. Don't compare 2018 to 2008, probably still on the upward trend cycle, not at the end, even though we are in lofty areas. And in terms of a 50% crash, if you're looking for that, you're going to wait a while. It's going to be every 30 years. Definitely a 20% drop, and probably some sort of a quick recovery after that. I believe after the 87 crash even, which was a 25% in one day, 30% max drawdown, we got back to flat within a year, right?
I believe it was a year, yeah.
Yeah, and so
we hope there's not a 50% drop more frequently than every 30 years, since we've had enough in the last couple of decades. But all right, well, thanks everyone for joining. And
next month we'll probably cover a new scenario on a liquidity crisis. We keep reading about the trend toward index investing away from active management, and so all the people are ending up in the same boat, in the same investment vehicles. And so what if, will that, as a volatility happens or an exodus from a certain fund happens, let's say from spiders or anything, will that cause a liquidity crisis because everybody's in the same vehicle? We'll address that. JP Morgan released its own report on that. We've been intrigued, and we thought we'd create a new scenario. In ending, what I'll say is, if there is a next crisis, there's plenty of hogwash ones that are written about to sell newspapers. A real one might be that, and it's a little bit more complicated and market oriented as opposed to sexy and in the global conflicts or Main Street oriented. So we'll get down to it and see how we can make it more interesting to discuss with your clients if you are interested in a serious crisis. Until then, we'll be back in October, and do keep us in your thoughts. We're Hidden Levers. Thanks a lot for joining us, Praveen.
Thank you. See you next month.